Is a recession coming in the U.S.? Understanding the economic signs, causes, and potential impact recessions are periods of economic decline that affect everything from job security to the stock market and even global trade. As of 2025, growing concerns over inflation, interest rate hikes, geopolitical tensions, and slowing consumer spending have triggered fresh fears that the U.S. economy may be heading toward a recession. But is it inevitable? Let's explore the warning signs, causes, and real-world impact of a potential U.S. recession. What is a recession? A recession is typically defined as 2 consecutive quarters of negative GDP growth. But more broadly, it includes widespread declines in economic activity, including rising unemployment, decreased consumer spending, declining business investment, falling industrial production. The National Bureau of Economic Research, NBER, also considers indicators like income levels, retail sales, and employment when declaring a recession. Current warning signs. As of 2025, several red flags are currently fueling recession fears in the U.S. High interest rates. The Federal Reserve has maintained high interest rates to combat inflation, leading to more expensive borrowing for businesses and consumers. Rising corporate layoffs, tech, finance, and retail sectors have begun cutting jobs in anticipation of slowing growth and reduced profit margins. Inverted yield curve. When long-term interest rates fall below short-term ones, as seen in 2024, it historically signals a looming recession, slowing consumer spending. Credit card debt is at record highs while household savings are shrinking, suggesting reduced purchasing power. Weak global demand. Economic slowdowns in China and Europe are reducing demand for U.S. exports, impacting industrial output. Causes behind a possible U.S. recession: persistent inflation. Although inflation has slowed from its 2022 to 23 peaks, prices remain high across essentials like housing, food, and healthcare, squeezing middle-class budgets. Monetary tightening. The Fed's rate hikes have made mortgages, auto loans, and business credit costlier, chilling economic momentum. Geopolitical uncertainty. Wars in Ukraine, the Middle East, and tensions with China over Taiwan create instability in trade and oil markets. Debt crisis. U.S. national debt has surpassed $34 trillion, and rising interest payments limit government flexibility to stimulate the economy. Commercial real estate decline. As remote work becomes permanent, offices remain empty. Real estate defaults could ripple into the banking system. Sectors most likely to be hit: tech and startups. Venture capital is drying up, and many startups dependent on funding are downsizing or closing. Retail and hospitality. Consumers cut back on non-essential spending, hitting restaurants, travel, and retail chains. Construction and real estate. High mortgage rates, slow housing sales, and new construction projects, hurting related industries. Financial sector. Banks may tighten lending, and rising loan defaults could stress regional and mid-sized financial institutions. Impact on the average American: job losses. Recession leads to layoffs, especially in vulnerable sectors like tech, real estate, and hospitality. Lower wages and fewer raises. With companies conserving cash, wage growth typically slows or freezes. Harder to get loans. Borrowing becomes tougher as banks raise standards for mortgages, car loans, and credit cards. Retirement and investments affected. Stock markets and 401k portfolios typically fall, causing anxiety among retirees and investors. Mental health and social strain. Financial stress can contribute to rising depression, anxiety, and even substance abuse in households. Global ripple effects. A U.S. recession has international consequences. Export-oriented countries, nations reliant on selling goods to the U.S., like Mexico, Germany, and China, will see reduced demand. Currency instability. Investors often flee to the U.S. dollar, which can hurt emerging markets by increasing debt costs. Oil and commodity prices. Falling demand in the U.S. often triggers a drop in global oil prices, impacting oil-exporting nations. Is there hope? Counterforces preventing recession. Despite the gloom, some indicators offer hope. Strong labor market. Still, unemployment is low, approximately 4% as of Q1 2025, and job creation remains resilient in healthcare, education, and defense. AI and tech innovation. New waves of AI-driven productivity in healthcare, manufacturing, and logistics may boost growth in late 2025 and beyond. Manufacturing reshoring. U.S. companies bringing production back from China may drive local job creation. Federal stimulus potential. If recession deepens, the government could deploy stimulus measures, tax breaks, or infrastructure spending again. What should you do to prepare? Build a 6-month emergency fund, reduce high interest, debt, avoid risky investments, strengthen your job skills or explore recession-proof careers, diversify income streams, side hustles, freelancing, etc. While a U.S. recession in 2025 is not guaranteed, many warning signs are pointing toward economic slowdown. Whether it's temporary or prolonged will depend on how policymakers respond and how resilient businesses and consumers prove to be. For individuals, the best strategy is to stay informed, plan ahead, and adapt wisely.